Nearly 60% of Americans cannot cover a $1,000 emergency expense without going into debt. One unexpected car repair, one medical bill, or one job loss can instantly wipe out years of hard-fought financial progress. Yet, when people start focusing on their money, the first thing they look for is passive income. They want to jump straight into dividend investing and start earning cash while they sleep. This creates a very real dilemma. When you finally have extra money at the end of the month, what is the safest, most efficient place to actually put it? To answer that, we look at this simple chart comparing your two main options: liquidity, how fast you access cash, versus yield, how fast cash grows. A traditional bank sits here at the bottom left. You get money instantly, but it earns practically nothing. If you prioritize income before safety, the entire system remains fragile. A stable financial strategy starts with securing the foundation before focusing on the growth. That defensive firewall is your emergency fund. This is a dedicated pool of cash set aside exclusively for unexpected, mandatory expenses. Not a vacation, not a sale, a true emergency, like a job loss or a blown transmission. To find your target number, tally up your bare minimum survival expenses: rent, groceries, utilities, and insurance. If your job is stable, multiply that by 3 months. If your income fluctuates, aim for 6 to 12 months. Next, look at this comparison matrix to decide where to keep those funds. If you leave it in a traditional bank earning 0.01% interest, you are guaranteeing a loss of purchasing power against inflation every single day. If you go to the other extreme and invest it in the stock market, you get high yield potential. But if an economic downturn hits and you lose your job, you'll be forced to sell your investments at the exact moment they've dropped in value. The optimal middle ground is a high-yield savings account. Right now, these pay 4 to 5% APY, and they offer full FDIC insurance protection, so your principal is entirely safe. High-yield savings accounts buy you time. They ensure that when a crisis hits, your long-term investments stay untouched and continue to compound. Once that firewall is fully funded, the defense phase is over. Every single surplus dollar you earn after that point must be entirely redirected toward generating new cash flow. This brings us to dividend investing. When a company makes a profit, it can choose to share a portion of those earnings directly with its shareholders, usually on a quarterly basis. We measure this using dividend yield, the annual income the investment generates relative to the amount you invested, expressed as a percentage. This creates a genuine passive income stream. Cash is automatically deposited into your brokerage account, and you never have to sell a single share of the underlying asset. For most people starting out, broad dividend ETFs like SCHD or VYM are vastly superior to picking individual stocks. With a single ETF, you get instant diversification across hundreds of companies, meaning if one business cuts its dividend, your portfolio barely notices. The objective here isn't to get rich overnight. You are acquiring assets that will produce a predictable, permanently growing stream of cash over the course of your life. There is an alternative to standard ETFs. If you need maximum immediate income, you can use covered call strategies like the JEPI ETF, which currently yields around 7 to 8%. But there is always a strict trade-off. By securing higher monthly cash flow today, you are sacrificing the long-term price growth of the underlying stocks. Let's look at the real-world math. A $50,000 balance in a standard ETF like SCHD generates about $146 a month, enough to cover your utility and grocery bills. Scale that up to a $200,000 portfolio leaning into high-yield ETFs, and you are looking at $10,000 a year in pure passive cash flow. If you don't need that cash to live on right now, you can trigger an accelerating feedback loop using a DRIP, a dividend reinvestment plan. This automatically uses your dividends to buy more shares, which then pay you more dividends. This graph illustrates exactly how that plays out. A 25-year-old who invests consistently and reinvests every dividend moves off this flat savings line and creates a steeply curving massive passive income stream by age 55. Aggressive reinvestment over decades turns a modest starting yield into a dominant income stream. At this stage, the compounding effect matters more than the initial deposit. Building this successfully requires both pieces: the high-yield savings account for your defense and the dividend ETFs for your scalable offense. To figure out where your money should go today, we can use this flowchart. the next dollar protocol. The first note asks a simple question. Do you have 3 to 6 months of essential expenses saved? If you haven't hit that 3-month threshold, you are still vulnerable. Ignore the dividend type. Route every surplus dollar into a high-yield savings account until perfectly secure. If you already have a fully funded safety net, we ask, what is your primary goal? If you have a 10-year or longer time horizon and want your income to snowball automatically, you are a foundational optimizer. Your route is straightforward. Allocate your capital to broad ETFs like SCHD or VYM and immediately turn on automatic dividend reinvestment. But if you have significant capital already and need immediate monthly income to offset your present-day expenses, your profile changes. You will want to look at a strategic allocation into a high-yield covered call ETF like JEPI to maximize your monthly payouts today. Selecting the best financial product matters less than matching the right asset to your current level of risk. Sequence determines the outcome.